Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, August 9th, 2024. If you only looked at where the S&P 500 index finished last week compared to where it is this afternoon, you might think not much has happened during the past week in the stock market. However, just 2 days ago, the index was at its lowest point in 3 months and had a lot of people wondering if this was the beginning of a major correction. So here's our chart of the S&P 500 year to date. You can see the peak here in July, just 3 weeks ago or so, and then the big drop off here. Now, if we zoom into just 1 month, you can see the big drop here really it began last Friday, then continued into this Monday, a little bit of a rally Tuesday, and a big drop on Wednesday. But yesterday, the weekly report on jobless claims reassured Wall Street that the jobs market was not imploding. That triggered a rally in stocks that has recouped most of this week's losses. The same holds true for tech stocks as measured by the NASDAQ Composite Index, which officially fell into correction territory 2 days ago after falling more than 10% from its all-time high achieved 4 weeks ago. So here's the NASDAQ Composite, which is dominated by tech stocks. Similar pattern as the S&P 500, just a bit more extreme. And again, if we zoom into 1 month, you can see also the big drop late last week. So you can see the peak here almost exactly a month ago. When it bottomed out down here, it was more than 10% below that peak. So we had officially a correction for just a day or two, but in the last 2 days, it's come back out of that. Now, while all that was happening, the yield on the 10-year Treasury note fell below 3.7% on Monday. Now, here's the year-to-date chart on the 10-year Treasury note. And look at this big drop over here, late last week, early this week. And again, if I zoom into 1 month, you can see down here on Monday, bottoming out a little below 3.7. At the same time, the CBOE Volatility Index, or Fear Index, spiked to its highest level since the coronavirus pandemic threatened to shut down the global economy 4 years ago. Now, here's a year-to-date chart of the CBO Volatility Index, and remember, the higher it goes, that means there's more fear in the market. You can see this huge spike way over here on the right. And by the way, that understates it because that just takes the closing value of 38.57. But if you actually look at the intraday prices and you go back a few days and you look at where I'm pointing here, on the 5th, it jumped up above 65, and that's the number I'm referring to that rivals what was going on 3 and 4 years ago during the pandemic. So that shows you that a lot of portfolio, and the way the VIX works is it's the ratio of short-term put contracts on the S&P 500 index versus calls. And of course, put contracts, people buy those when they think the price of something's going to go down, which drives this ratio up. So at the start of this week, a whole lot of professional portfolio managers were buying puts on the S&P 500 index to protect their portfolios. And that's a more efficient way of doing it than selling stock. So anyway, you can see, though, it's come down quite a bit in just the last 2 days. In short, Wall Street hit the panic button at the start of this week. But as I noted a week ago, something similar occurred 2 years ago when the Silicon Valley Bank failure triggered a brief wave of panic that quickly subsided once it became apparent that the rest of the banking sector was on solid footing. Now, I went on to opine, I believe something similar will happen this time. The cap-weighted indexes were so overvalued to begin with, so some reversion to the mean was inevitable. And that's exactly what we got. A few days of indecision triggered a wave of panic selling, followed by the realization that nothing about the economy has changed enough to justify that extreme reaction. Much of this week's volatility in the financial markets has been attributed to the so-called Japanese yen carry trade. While Japan's central bank was suppressing interest rates to almost zero, global investors borrowed money from Japan to invest in higher-yielding stocks and bonds in the United States and elsewhere. But when the Bank of Japan raised its interest rates recently, that triggered margin calls that forced those investors to sell the assets that they had purchased with that borrowed money. That type of interest rate arbitrage is a dangerous game to play and almost always ends badly. Experienced investors may recall the implosion of hedge fund long-term capital management in 1998 after it bet heavily on global currencies and bond prices, including the Russian ruble. That event triggered a brief stock market panic, but had no long-term effect on the stock market. In short, this has happened before and it'll happen again. Hopefully, industry regulators will one day figure out how to prevent such actions from having such a pronounced effect on the global financial markets. But until then, it's an unfortunate reality that we all have to live with. That's this week's update, and I look forward to talking to you in another week.